Okay, the first problem on our list is M3-1. M3-1 indicates that Mozart Music Company had the following transactions. It gives you the list of transactions, and then the only actual requirement that it gives you is to put in numbers for the accrual basis income statement versus the cash basis income statement, okay? But I think it's more beneficial for us to go over the journal entries behind an accrual basis versus a cash basis so we understand why we're putting the inputs we are into each one of these financial statements. I think it'll make more sense. I've also kind of summarized over here what the T accounts will be for an accrual basis, which will help facilitate putting these in, just as a little more added practice. You don't have to do these parts, but I want to explain them to you just so I think it'll make more sense. All right, let's analyze each transaction here. First one on M3-1 is A. Mozart Music Company sold music lessons to customers for $10,000, received $6,000 in cash, and the rest on account. So, journal entry here for an accrual basis accounting will be debit cash, debit accounts receivable, and credit revenue. All right, total amount of revenue we had was 10, 6,000 was received in cash, 4,000 or the rest was received on account. Now, when we look at this, on an accrual basis accounting, you can earn revenue and not necessarily receive cash. You might have heard me say in a previous video that cash is not the same thing as income, or cash is not even the same thing as revenue, okay? On an accrual basis accounting, you can earn revenue but not necessarily receive cash, okay? Revenue has to be either realized or realizable and then also earned. Realized would mean it's already cash. Realizable would mean it can be turned into cash, i.e. accounts receivable. And earned means that you've actually earned your revenue. Either you performed the service or you provided the product, or if it was rent revenue, you've allowed someone to use the facilities that they're renting. It depends on the type of revenue that you're earning as to what constitutes earning, but in general, you can think of it as either providing the service or providing the product, okay? Now, on a cash basis accounting, the driving force behind what the journal entry would be is whether or not we received cash or paid cash. In this instance, the only cash that we received was the $6,000. Therefore, the only revenue that we record is the $6,000, okay? Driving force here is whether or not you've received or paid cash. Driving force on accrual basis for revenue is whether or not you've earned the revenue. And for expenses, it's whether or not you've incurred the expense, which we'll talk about a little bit later. All right, B. B says we paid $600 in wages for the month. In this instance, for B, we've paid the wages on either, it doesn't matter which basis that we're going, accrual basis accounting or cash basis accounting, we paid the wages either way, okay? So, for accrual basis accounting, we've incurred an expense because the employees have worked. That's the driving force, but we paid the wages, so we'll credit cash here. The amount was $600, so I'm going to put 0.6 here. Okay, and then over here we'd have the same journal entry for cash basis. It's an expense not because we've incurred the expense, but it's an expense because we've paid the cash, and that's for cash basis accounting. Remember, this problem illustrates the difference between the two, but only one is acceptable for GAAP, generally accepted accounting principles, and that's the accrual basis. Cash basis accounting we do not use for GAAP. We are learning the accrual basis, but we're doing this problem to illustrate the difference. Going to part C, it says we received $200 bill for utilities that will be paid in April. Okay, again, we've incurred the expense, so we'll use utility expense here. We'll say accounts payable, and this was $200. Okay, notice we're recording the expense. Why? We're going to pay the bill in April. We have not yet paid it. However, it's assumed that we've incurred the utilities expense because we've used the utilities during March. So March is when we used them. We'll pay them in April. But in order to find when you've incurred an expense, you want to find the point at which you've received a product or received a service. Okay? In this instance, we received a utility service during March that we'll pay for in April. Therefore, we don't credit cash because because we're paying in April, but we credit accounts payable because we owe the utility company, and we debit the expense because we've incurred the expense. For cash basis accounting, there's no journal entry. Why is there no journal entry? Because there's no cash that's been exchanged. The driving force is whether or not we've paid cash, and that's the only reason why we record an expense. Here, because no cash is being exchanged, we have no journal entry to record. Next, we received $1,000 from customers as deposits on music lessons to be given in April. In this instance, we've received cash, so on the accrual basis accounting, we record cash. However, we have not yet earned the revenue. Remember, this is a deposit for services to be given in April. Because we have not paid or given those services, we've not provided those services, okay, we cannot credit revenue. So what do we credit? In this instance, we use an account called unearned revenue. Okay? Unearned revenue is not revenue. Please drill that into your mind. Unearned revenue is not revenue. Unearned revenue is a liability. Why is it a liability? Think about what the term means. Unearned. You have not earned the revenue. It means you still have an obligation to perform. If it's a product, you still have to deliver it. If it's a service, you still have to provide it. You have some sort of obligation that you still have to do, and therefore you have not yet earned your revenue. When you earn your revenue, you will reduce this account and increase a normal revenue account. But this account right here, this unearned revenue account, is considered a liability, which means it shows up on the balance sheet, not the income statement. Now let's go over here to cash. What does the cash basis accounting care for? Cash. It's received cash of $1,000. Could care less whether or not it's actually performed the service, so simply records revenue here of 1, okay? Now, let's sum up these and determine what exactly we should record in each one of the financial statements. In order to facilitate that, I've already did some calculations over here for the T accounts. I posted each one of these transactions on the accrual basis over to the T account. Now we can use these totals and bring them over to the income statement. So for accrual basis accounting, for revenue, we have 10, okay? It gives you the format, so it tells you exactly what accounts should be affected. For expenses, it tells us that wage expense was incurred. Well, we'll go over to wage expense here. We have 0.6, so I'm going to put 0.16 for 600. And then utilities expense, we have 0.2 over here. And then I've added up the total here, so the total should be 9.2 for net income under the accrual basis accounting. Now let's go over to cash basis accounting here. It tells you that for sales here, well, we have 6 here and 1 here, so 6 in the sales that we made and then 1 in the deposit that we made here. That's our revenue. And then for expenses, we should have a wage expense, so that's 0.6. So if we sum this up here, we get net income here at 6.4. Now, the interesting thing to note, and the thing that I want you to realize, the whole reason why we did this problem is, neither one, cash basis nor accrual basis, had different transactions. Both of the transactions were exactly the same. However, look at how they produced different results. This goes to support the whole reason why accounting is a framework set up, principles and standards established, rules to follow, that tell one company this is the correct way to report, so that company A can be comparable to company B. If not, then you have one company saying cash basis is the best to use, cash basis is the easiest to use, and reporting the same transactions to equal this net income. Whereas this company over here, okay, says accrual basis is the best way to use. Let's report these same transactions and get this net income. Both companies can then not be compared one to the other. You wouldn't be able to rely on which company is doing what, okay? It's the whole reason why we have established a framework for accounting. Look this over. Please let me know if you have any questions on problem M3-1.